You know how some businesses just seem to have this knack for growing, for handling their money smartly, while others seem to constantly face financial headwinds?
Yeah, definitely.
Today, we're going to really dig into what separates them. We're exploring investment management and entrepreneurial finance.
Exactly. And these aren't just, abstract ideas. They're really the practical engines that drive a business forward.
The engines. How so?
Well, they provide both the fuel for growth and the strategic navigation. You need both for long-term stability.
Okay.
So investment management is more about making the most of the financial resources a company already has, making sure they're generating good returns, managing risks,
Right. Maximizing what's there.
precisely. And entrepreneurial finance. That's focused on securing the capital needed to launch and scale new ventures,
Now,
getting things started.
okay, so if a business has funds already, investment management is like having a financial strategist, someone who knows exactly where to put those funds for the best outcome, like a chess player thinking moves ahead.
That's a great analogy, actually.
Yeah.
Yeah. Drawing from this article by Nisha Dior at Cognitive Market Research, investment management really centers on strategically enhancing a company's asset portfolio.
Through well-informed choices, presumably.
Exactly. Informed investment choices. It's a careful balancing act, between pursuing potentially high returns and um, diligently assessing and mitigating risk.
So what does that look like day to day?
Well, the core activities involve detailed analysis of market trends, a really keen awareness of potential financial vulnerabilities, and, crucially, aligning investment decisions with the company's big picture goals.
Okay.
Ultimately, the aim is always to significantly improve financial performance and, maintain that competitive edge long term.
In entrepreneurial finance,
Yeah.
that's more about getting the initial pieces on the board in the first place, finding the resources to bring an idea to life, fuel that initial expansion.
Precisely. As the article highlights, it specifically addresses the unique financial demands of new and growing businesses.
Which are pretty significant, I imagine.
Oh, absolutely. So this includes the critical process of securing initial funding, maybe through venture capital or angel investors or even crowdfunding now,
Right.
and then skillfully managing those funds.
Mhm.
That means effective budgeting, robust financial planning, and meticulous monitoring of cash flow.
Cash flow seems key.
It's vital. The fundamental aim here is really to transform innovative concepts into viable, sustainable businesses, businesses that contribute to, well, broader economic growth.
It really does sound like two sides of the same coin, doesn't it? One, maximizing existing resources, the other, acquiring and managing resources for growth.
Exactly. The article makes a point about their complementary nature being foundational for success.
So, how do these actually work on a practical level? What are the kind of strategic steps involved in each?
Okay, so in investment management, the process typically kicks off with setting very clear, measurable financial goals. And these have to be directly tied to the company's main objectives.
Makes sense. You need a target.
You do. Following that, there's an in-depth examination of market conditions, potential risk factors, all to inform the actual investment decision.
Okay.
A crucial element here is portfolio diversification. We mentioned that spreading investments across different asset classes so you're not over-reliant on one thing,
Don't put all your eggs in one basket.
the classic advice. And finally, and this is critical, it's not a set it and forget it deal. Continuous monitoring and periodic rebalancing of the portfolio are essential to adapt to market changes. Markets are always moving.
That makes perfect sense. You can't just invest and walk away. You have to keep checking, adjusting.
Yeah.
Okay, now what about for someone starting a business? What are the initial steps in entrepreneurial finance?
Right. For entrepreneurial finance, the first critical step is clearly identifying the specific financial needs of the new venture.
Like what you actually need money for.
Exactly. Startup costs, day-to-day operations, the capital needed for growth down the line. All of it. Next, entrepreneurs need to explore and actively pursue funding options. Preparing pitches for VCs, seeking out angel investors, maybe looking into loans.
The fundraising hustle.
That's a big part of it. Once funding is secured, the focus shifts to effective financial planning and rigorous budgeting, making sure the funds are allocated strategically to hit those development milestones.
Got it.
And mirroring investment management in a way, ongoing financial management, especially that diligent cash flow monitoring, is absolutely vital for survival and sustainability.
Right, you need that constant oversight. So the article then breaks down some core components within each area. Let's start with investment management again. It mentions asset allocation, risk management, and portfolio diversification. Why are these three so fundamental?
Okay, think of it this way. Asset allocation is like Like building the basic framework of your investment strategy, deciding how much goes into stocks, bonds, real estate, other things.
The mix.
The mix, exactly. The goal is to get a mix that offers the best balance between potential returns and the level of risk the company is comfortable with.
And risk management.
Risk management, then, is about identifying threats to that framework, market downturns, specific investment failures, things like that, and actively taking steps to minimize their impact.
Protecting the downside.
Precisely. And portfolio diversification, as we've discussed, is a key tool within risk management. Spreading investments across different areas so a negative event in one sector doesn't, cripple the entire portfolio. Have you ever sort of diversified in your own life to protect yourself?
That's a good question. I guess maybe like in freelance work, not relying on just one client. If they leave, you're stuck. Diversifying your client base gives you a safety net.
Exactly that kind of thinking. Perfect example.
Okay, so on the entrepreneurial finance side, the key components mentioned are capital acquisition, financial planning, and cash flow management. How do these three work together?
Right. So capital acquisition is the lifeblood, really. It's getting the necessary funds from those sources we talked about, VCs, angels, etc.
Step one, get the money.
Pretty much. Then financial planning takes those acquired funds and creates a detailed roadmap. How will they be used? Budgets, expense forecasts, financial targets?
The plan to the money.
Exactly.
Okay.
And finally, cash flow management. This is about ensuring the business has enough liquid cash coming in to cover its immediate bills, salaries, suppliers, rent.
Keeping the lights on.
Literally. Without careful cash flow management, a business can actually become insolvent, even if it's making sales on paper. It's like making sure you always have enough fuel in the tank to reach your destination, even if the journey takes unexpected turns.
So both established companies and startups need these core functions working together, but the article also points out limitations. What are some challenges in investment management?
Well, a primary one is just the unavoidable reality of market volatility.
Things go up and down.
Right. Even with rigorous analysis, investment values fluctuate, sometimes significantly, and that impacts returns. Also, the sheer complexity of global financial markets makes accurate long-term prediction.
Well, incredibly challenging. There's always potential for unexpected losses.
That inherent uncertainty. You can plan, but you can't control everything. What about limitations for new businesses in entrepreneurial finance?
For entrepreneurs, a huge hurdle is often just access to capital.
Getting that first check.
Yeah. Securing funding, especially early on, needs a compelling plan, often a track record, which is tough for brand new ventures.
Right.
And another thing, relying on external funding like venture capital can sometimes mean giving up some control. Investors often want a say in decisions in return for their cash.
The trade-off for funding.
It can be.
And the article mentioned a shared limitation too, something affecting both.
Yes, both areas demand a considerable investment of time and resources.
Continuously monitoring portfolios, doing deep financial analysis, adapting strategies, it all requires dedicated people and effort. This can be particularly tough for smaller businesses or startups with limited staffs and budgets.
So recognizing these limitations is key.
Absolutely. It allows businesses to be realistic and proactive.
Okay, but despite these challenges, the article really emphasizes the advantages of doing this well. Effective financial planning and forecasting. What are the big benefits?
Well, one of the most significant is enhanced decision-making.
How so?
By having solid plans and forecasts, businesses can anticipate future financial needs, allocate resources much more efficiently, and make informed strategic calls based on projections. This really reduces the risk of financial instability.
So it gives you a clearer view of the road ahead, helps you steer better. What else?
Improved strategic planning is another crucial advantage. Financial forecasts give you valuable insights into market trends, potential opportunities, possible risks.
Right.
This lets businesses align their overall strategies with long-term financial goals, set realistic targets, prioritize investments, and importantly, evaluate their performance against actual financial benchmarks. It ensures the business goals are actually financially sound.
And I guess this also makes businesses tougher, more resilient.
Absolutely. Effective financial planning directly leads to better risk management. By analyzing different potential scenarios, what if sales drop? What if costs rise? Businesses can develop contingency plans, build up reserves.
Preparing for rainy days.
Exactly. That preparedness is essential for long-term survival in, let's face it, a pretty dynamic business world.
Now, the article also brings up secondary market research, its role in both investment management and entrepreneurial finance. Just to be clear for everyone listening, what is secondary market research?
Sure. Secondary market research is basically analyzing existing data, information that's already been collected and published.
Like what kind of data?
Oh, things like industry reports, government statistics, financial statements from public companies, market analysis reports. It's about using publicly available info to get a broader understanding of market trends, industry dynamics, the competitive landscape.
Okay, using what's already out there. And how does this help investment managers?
For them, it's invaluable. It helps understand macroeconomic trends, assess how different industries are doing, analyze historical investment data.
Right.
This information helps them make smarter decisions about asset allocation, portfolio diversification, basically refining their strategies to anticipate market shifts and manage risks better. It provides that crucial big picture context.
And for entrepreneurs trying to get funding or understand their market, how does secondary research help them?
Well, it offers critical insights into funding trends, what kinds of businesses are getting funded. It helps understand investor preferences, industry benchmarks.
Knowing what investors look for.
Exactly. Entrepreneurs can use this to identify potential funding sources, understand investor expectations better, and even assess the market viability of their idea. It helps them refine their business plans and financial projections to be more compelling.
The article mentions an OECD statistic, a 5.1% increase in worldwide business investment in 2022. That sounds significant. How does a broad trend like that, found through secondary research, connect back to what we've been discussing?
That's a perfect example. A statistic like that is a macroeconomic trend with direct implications for both fields.
Okay.
For investment managers, rising global investment might signal a more optimistic economy. They might adjust their strategies to capitalize on expected growth.
Right.
For entrepreneurs, it could mean a more favorable environment for securing funding. Increased investment activity often reflects more confidence in the market, more willingness to deploy capital. So this high-level data, often from secondary research, provides this vital backdrop for decisions.
Got it. Lastly, the article points to some key drivers for the investment management market specifically. Things like global economic growth, tech advancements, rising income, and diversification needs. Can you quickly touch on how each of these drives things?
Sure, so strong global economic growth. That generally fuels business expansion, creates more attractive investment opportunities. Pretty straightforward.
Okay.
Technological advancements, think AI, big data, automation. These are enhancing the tools for investment analysis and decision-making, allowing for more sophisticated strategies.
Better tools, better analysis.
Potentially, yes.
Yeah.
Then rising disposable income means more money, both individual and institutional, available for investment, just increases overall market activity.
More fuel for the market.
Right. And finally, that growing awareness of diversification's importance. It's driving investors to seek a broader range of assets, different classes, industries, geographies. This directly influences how investment managers build and manage portfolios.
So these big picture drivers shape the whole landscape.
They absolutely do. And they're often identified through that broader secondary research and economic analysis we talked about.
Okay, so we've really covered a lot of ground in this deep dive, explored this essential relationship between investment management and entrepreneurial finance.
We certainly have. We've seen how investment management focuses on, strategic growth and risk management of existing assets, while entrepreneurial finance is crucial for getting and managing the funds for new and growing businesses.
Right, and we looked at the key processes, the components within each, acknowledged their limitations because nothing's perfect.
True. And highlighted the significant benefits of proactive financial planning and accurate forecasting.
And we also underscored that really vital role of secondary market research, providing that broader context for making informed decisions in both fields.
Exactly. By analyzing market trends, understanding investors, using industry benchmarks, both investment managers and entrepreneurs can seriously enhance their strategies and hopefully increase their chances of long-term success.
So as we think about this complex interplay, between global economic shifts and rapid technological innovation, it leaves us with a really interesting question for you listening. How might individuals or businesses proactively position themselves to really harness the power of both investment management principles and entrepreneurial finance strategies? How can you use both to drive future growth and foster innovation? It's definitely something worth pondering as you navigate your own understanding of today's business and financial landscapes.